Ever wonder why some people always end up on top with every economic change while the rest of us face steeper prices? It's not just luck, it's a phenomenon called the Cantillon Effect. This theory explains how new money entering the economy doesn't distribute evenly, leading to inflation and wealth disparities. We're going to dive in and show you how this works and why it's more important than ever. Now, giving credit where credit is due. This video is inspired by one of our comments on our channel. We thank everyone for all the comments. We read every single one, and we encourage you to give us some more great ideas. The Cantillon Effect was created by Richard Cantillon, an Irish-French economist, published in the Essay on the Nature of Trade in General, published in 1755. It describes the inequalities of inflation. Changes in the money supply can lead to an uneven distribution of wealth. Now, let's start from the beginning. Money enters the economy from the central bank in the form of quantitative easing or just very simply the manipulation of interest rates. The banking system, government agencies, and private equity, and Wall Street as well, they're the first recipients. That's the first line of where the capital usually flows after coming out of the central bank. Now let's talk about money, otherwise known as M2. M2 in the Federal Reserve's estimate of the total money supply, including all cash people have on hand, plus all money deposited in checking accounts, savings accounts, other short-term saving vehicles. It's basically all cash. Now let's take a look at M2. This goes back to the year 2000, and we can see there are certain periods of time measured here on a year-over-year basis that M2 really increased. What this is showing us, such as 2001 through 2003, is the supply of cash, the physical amount of cash within the economy increased dramatically. This also occurred in the 2008-2009 financial crisis, and most dramatically during the COVID crisis, 2020-2021. That's when interest rates were lowered and there were a ton of different programs that flooded the economy with extra money, otherwise known again as M2. Now, inflation follows M2. We know this intuitively. In blue, that's M2 on a year-over-year basis. In red, consumer price index, the best measure of inflation. And we can see 2020, 2021, a massive spike in M2 that was followed in the next year or so by an increase in inflation that we're still dealing with today. Individuals and organizations who receive the money first are able to spend it before inflation follows. And this is really the most important point. The cycle begins with the central bank. Now, capital ultimately moves in the direction of investment assets, such as real estate. Inflation follows the newly printed money. Now, smart money is able to front-run inflation. What's smart money? It's, according to the Cantillon Effect, it's those that are most closely connected with the decision makers. Again, the banks, private equity, Wall Street. The people that really decide where this money is going to go, and as well as the banking system, well, they're able to take advantage of this. They see where the capital is flowing and they're able to make investments. In other words, they're able to buy at pre-inflationary levels, pre-inflationary prices. Imagine buying real estate before the inflation. Imagine buying the stock market before inflation. That's where the smart money is. The general public follows a trend and usually ends up paying for the same assets, but at inflated prices. Now, M2 and the housing market in particular, here in blue, M2, the supply of money on a year-over-year basis. In red, median sales price for new houses, again, also on a year-over-year basis. In this case, 2011, 2012, we saw an increase in the level of M2. This is obviously coming out of the financial crisis of '08. And notice, about a year later, the median sales price for homes dramatically spiked to the upside. There's no accident why this occurred. In layman's terms, capital flooded the market and the capital had to find an asset eventually, to be parked. Now, how do we time the trade? And it's not just luck. There's actually math involved. Here we're going to take a look at the correlation between M2 and new home prices. Now, we took a ton of data going from 1990 through present date. What's the correlation between the amount of extra capital that's flooding the system and new home prices? How long does it take for that money to move from the central bank into our real estate market so we can see the effect? How many months does M2 take to move ahead, or how many months does M2 move ahead of the housing markets? How long do we have to wait? Let's try to time the trade. Well, here we can see on average, and this is again, we're measuring correlations from 1990 through present date. This is a lot of data. 12 to 14 months. What does this mean? It means on average, over the past 34 years, if we were to take a look at those moments that M2 dramatically increased, on average, it takes about 12 to 14 months for that M2, that extra capital, to make its way through to find the real estate market, but also to show its results in the real estate market. This shows us the year-over-year change of M2 compared to the year-over-year change of new home prices. And that's when we actually see the correlation works the best. The best correlation is if you delay home prices by 12 to 14 months. Where are we now? Well, in blue, M2, very much to the downside as a result in part of higher interest rates. Higher interest rates absorb that extra capital. It's trying to cool down inflation, so it's sucking capital out of the banking system, out of the financial system in the form of higher interest rates, higher credit card payments. And that has also shown itself in terms of the median sales price for new houses. Now, I know we look at the home price market and it's at or near all-time highs, but on a year-over-year basis, it's actually slowing. It's not as hot as it was this time last year. Why is this important now? M2 is slowing and the real estate market is slowing. Why are we talking about this? Well, we're about to get a new administration. New administration means new spending, and this is not a, Democrat, Republican. It's, equal to both sides. With a new administration, we can expect a combination of maybe subsidies, maybe tariffs, interest rates, quantitative easing, new contracts. There's a million different ways that we can see new decisions that will be made that will guide the capital in one form or another. It could be lower interest rates. It could be quantitative easing if the economy gets itself in a lot of trouble, or it just could be new government contracts. What we're going to really try to do in the months that come ahead is we're going to try to, really pay a lot of attention, especially after the elections, to see the next decisions that are made, to see where capital might be allocated. So maybe we can anticipate the next strong trends in the economy, whether that be in the real estate market or in a particular sector in the stock market, for example, because we want to try to be that smart money that moves ahead of the inflation so we can buy pre-inflationary prices. We hope this has been helpful. We look forward to seeing you back soon.